In this week's video, we'll review the historical facts to help us answer the question, do stock valuations leave the door open for big gains or devastating losses? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. After we cover valuations, we'll circle back to this table and fill in this column here relative to things that we've covered since August 5th of last year. It's a daily chart of the S&P 500 index. This is 1988 on the left side of your screen. This is 2017 on the right side of your screen. These blue numbers are PE, or price earnings ratios. They basically tell us what an investor is willing to pay for $1 worth of earnings. A PE of 20 tells us that investors are willing to pay $20 for $1 of earnings per share. Here's a little blurb down here about the PEs that we'll be using. And the purpose of this exercise is to help us answer the question, how concerning are these numbers here in early 2017? If we review PE ratios as the stock market peaked in 2007, this is the peak before the financial crisis, we had a 21, a 22, and a 24. And if we go back to the late 90s, early 2000s, when the dot-com bubble started to lose some of its air, we see the PEs ranged from 27 all the way up to 31. Therefore, with this small sample size, we might conclude that buying or owning stocks when PE ratios are between 21 and 31 represents a poor risk-reward bet, and anything with a PE over 31 would be even worse. So if we just review these peaks in the present day, this does look quite troubling. 20 to 26 looks similar to 27 to 31 and 21 to 24. Would we reach the same conclusion if we expanded the sample size? Now we're looking at the same PE ratios from the same source using the same calculations. This is the bottom after the financial crisis. This is late 2008, early 2009. And we can see that these PEs in green range from 22 to 110, and that looks expensive relative to our 21 to 31 range, or if we said it's very dangerous to buy stocks when the PE gets over 31. This is quite a bit higher than 31. We have somewhat of a similar situation at this buying opportunity here at the low following the dot-com bust. In this case, our PEs here, as the market was bottoming, ranged from 20 to 38. Once again, if our rule was when PEs are between 21 and 31, that's a poor risk-reward bet, and anything over 31 is even worse, well, we have plenty of PEs in here between 21 and 31, and 38 is quite a bit higher than 31. These are market bottoms after a big drop. You can make an argument that that's not really where we are today. If we review PE ratios here in 1997 and 1998, the range in here is 20 to 27, once again telling us that these numbers up here aren't particularly helpful from a timing perspective. In recent months, we've talked a lot about the consolidation in 1994 and the breakout in 1995. These PE ratios here in green, using the exact same calculations used for these PE ratios in this area here between 1991 and 1994, range between 20 and 26, which sounds familiar. 20 to 26, the range in the present day going back to 2014, 20 to 26, illustrating that it's not particularly clear whether 20 to 26 is concerning and a time to run for the exits, or 20 to 26 is favorable and we might get a big run. Our range here is 21 to 24. Our range here is 27 to 31. We We have very similar PEs at these points in time, begging the question, if we said a PE of 20, 27, 27, or 20 was a reason not to buy and maybe a reason to sell, what happened next in the stock market after point A, point C, point E, and point G? So now we'll zoom into these periods, starting with point A. This is the same point A here. This is the S&P 500 index. The PE ratio at this point appeared to be high. It was 20. What happened after point A? The stock market broke out from the long-term consolidation box, and from point A to point B, the S&P 500 gained 232% over the next 6 years. And keep in mind, the starting PE was 20, meaning if we didn't buy or we exited because the PE was 20, we would have missed a 232% gain, and we would have been on the wrong side of the market for 6 years. Now we'll zero in to point C. Our PE at point C here in 1998 was 27. From a PE reading of 27, after that, the S&P 500 gained 58% over the next 540 calendar days. Zooming in to point E, our PE at this point in 2003 is 27. This is the S&P 500, which gained 59% over the next 4.2 years with a starting PE of 27. Zooming into point G, this is June 1st of 2004, starting with a PE of 20. The S&P 500 from point G to point H was able to gain 41% over the next 3.4 years. Coming back to this chart to summarize, the gain from point A was 232%, point C 58%, E as in Edward, 59% gain followed, G as in George was followed by a 41% gain. Sometimes it's a little easier to let a third party draw the conclusion. So let's review a little blurb from a Bloomberg article dated December 29th, 2016, which is just a few days ago. Valuation, history shows, is an awful tool for market timing. Equity cycles persist, and selling just because price-earnings ratios are high has repeatedly proven a mistake. From our perspective, this is the much more important analysis that we'll cover in this video. We're using a little bit different PE now. This is from stockcharts.com. This is the S&P 500's prior peak PE. You can look up on your own exactly how that's calculated, but basically think of this as the PE ratio here. Below is the S&P 500 index in black, and this is generally accepted accounting principle earnings. So this is just earnings down here on the bottom. We know from some of the videos that we've covered in recent weeks and recent months that 1982 represented an excellent entry point for stocks. And if we focus on this period here from 1982 to 1988, you can basically see that we have what's known as multiple expansion. PEs are getting higher. And typically we think that earnings have to skyrocket for the stock market to do well. This is the stock market from 1982 to 1988. This is a fairly significant gain here. It's hard to see on this chart. Multiple expansion, meaning PEs were expanding, was really the more important thing. Earnings didn't necessarily have to go through the roof here for the stock market to do well. Similar situation in 1995. We've covered the 1993, 1994, 1995 breakout case numerous times. The stock market takes off like a rocket here. Once again, we have PE or multiple expansion, meaning investors are willing to pay higher prices for that $1 of earnings per share. This is what's known as multiple expansion. And once again, you might think with the stock market going through the roof that earnings had to be going through the roof. Earnings did improve, but they weren't going through the roof. The slope of this line here isn't nearly as steep as the slope of this line here. And I think it's important to say I would classify all of this here as anecdotal evidence. This is probably more interesting than anything else. It's interesting to note where the PE expansion starts. PEs start to expand early in calendar year 1995. Then we get somewhat of a breakout in terms of the multiple expansion. There's some doubt here in investors' minds. They're not so sure they're willing to pay more for a dollar's worth of earnings. We get a breakout, a failed breakout, and then investors see something fundamentally that says they are willing to pay more for the same dollar's worth of earnings, and we get significant multiple expansion after the breakout. After the breakout, the stock market does extremely well, and once again, earnings improve, but they do not go through the roof. We have a very similar situation today. Down here, my PE bottomed in February of this year. We came up to an area that had acted somewhat as multiple expansion resistance. You can see investors are reluctant to pay higher PEs here, 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 and here. All of this acting as resistance. In calendar year 2016, we have a bullish breakout, a failed breakout, again, very similar to what happened here in 1995, and then we reclaimed the line here. After this breakout here, multiple expansion continued for a long period of time, and the stock market did extremely well. And if these anecdotal cases are any guide, it also tells us it's possible that the stock market could do very, very well with multiple expansion. We don't necessarily need earnings to go through the roof from a growth perspective. So to summarize, these two blue arrows here are somewhat similar, and these two blue arrows here show the breakouts. Obviously, our purpose here is not to forecast, just the opposite. We will head into next week, as always, open to all outcomes from wildly bullish to wildly bearish. When we summarize these two cases and say the stock market did very, very well, the stock market did very, very well, and earnings improved, but not necessarily dramatically or at a steep slope, the takeaway really in terms of multiple expansion, this is multiple expansion, a breakout and multiple expansion, is that markets operate more on psychology than on fundamentals. This is psychology here. The willingness to pay higher prices is much, much steeper than the improvement in earnings. The psychology improves. Basically, the outlook for the future, people become more optimistic here and they're willing to pay up. Maybe more of a psychological move rather than something based purely on fundamentals or improvement in earnings. In all three cases here, we're getting multiple expansion, 1982, 1995, and the present day. Clients and regular viewers know point A here, where multiple expansion starts. This is early 1995 here at point A. This is the exact same point A, and now we're just looking at a chart of the S&P 500. We've covered this numerous times. The longer a market goes sideways, the bigger the move that we can expect to get after a breakout. We don't know whether it will be bullish or bearish, and in this case, when multiple expansions started, people started becoming more optimistic about the future, that occurred simultaneously, for the most part, with this bottom here and then the breakout here. So a lot of these gains here are coming from multiple expansion. If you've reviewed historical PE ratios in the past, you might be saying, I don't remember PEs as high as 38, 83, or 110. The answer is most likely that you've been studying what's known as a forward PE. These are forward PE ratios here. The P used the present day price. The E is a forward projection for earnings. So these numbers here and these PE ratios are built solely on forecast of future earnings. So in this case, with the forecast, PEs can stay in a nice range where it looks like we're all under control and everything seems to follow somewhat of a script here. And PEs, going back to 1985, always fall between 8 and 26, telling us that when PEs get high, it's obvious it's time to sell. How does the exact same period look if we use actual reported earnings, so facts instead of forecasts? The same graph looks quite a bit different. Instead of having a nice tight range from 8 to 26, the range goes from 8 to 125. This is based on forecast. This is based on facts. If you've worked on Wall Street for a long time or have been in the markets for a long time, you know that these forecasts aren't particularly accurate, meaning you're much better off using actual reported earnings instead of forecasts. If we're reviewing PEs and we're just looking at the peaks and comparing them to the present day, it would be somewhat logical and rational to maybe assume when PEs get this high, it's because everybody's in. All of the cash is in the market and it's pushed PE ratios about as far as they can go. After the last person buys, in theory, then we get an awful bear market. After the last person buys, we get a devastating bear market. If we assume that everyone that's in the market today, let's just make the assumption that they're all fully invested, where could new cash come from to help propel stocks to make a move like this? Well, in the incredibly complex system known as the global economy, it's really impossible to answer that question definitively, but we can postulate. So let's cover one possible source of buying power. This is a Gallup poll from about mid-year last year, a little bit before April 20th, 2016. According to the Gallup organization in a Gallup poll, 52% of Americans say they have money invested in the stock market. How does that compare to previous highs or peaks where everybody is in that wants to get in? To get the answer, we can again turn to Gallup. According to Gallup in 2007, nearly 2 in 3 American adults, or 65% of the U.S. population, reported investing in the stock market. Here's the peak. This is 2007, and you can see rather than new people entering the market, the trend has been people have been leaving the market. We went from a high of 65% of the population invested to the reading last year of 52. Therefore, if we pull out our napkin and turn it over and pull out a pen and start doing some rudimentary calculations, according to Google, the U.S. population is somewhere in the neighborhood of 319 million. Therefore, if the percentage of people in the stock market return to the old high, which is here, 13% of the population could help push stocks higher. The 13% is basically taking the 65% that were in the stock market in 2007 and subtracting the present day of 52. 65% minus 52% is 13%. If 13% of the U.S. population sees the stock market going up and they're tired of hearing their coworkers and friends talk about the money that they're making in their 401ks, then the 13% might start migrating back. 13% of 318.9 million is roughly 41.5 million people. So you can somewhat make a back-of-the-envelope argument that since the peak in 2007, about 40 million people have left the stock market. If those 40 million people decide to return, That's a lot of buying power that would be returning to the stock market. And even if we assume that only half of those 13% return, that's still roughly 20 million people. And if only 25% of them return, that's still 10 million. We'll close the first weekly video of 2017 looking at the present day market. Clients and regular viewers know this is what a bearish turn looks like. This is the 50-day in blue. This is the 200-day here. This is the peak in 2000 before the bear market, and this is the peak in 2007 before the bear market. And we also know that a bullish turn is almost the mirror image here, with blue above red, and the slopes of both of the moving averages are positive. By looking at these extremes and these turning points, pretty much everything else falls in between, allowing us to learn something about the present day. This is the exact same chart with the exact same moving averages as of the close on Friday, January 6th. It goes without saying that the present day looks more like the bottom region over here than the top region. And if we wanted you to watch 3 hours worth of a video this weekend, we could show you all these charts. We know we all have things to do. Therefore, let's just update all of these charts by filling in this table here. The work that we've done dating back to August 5th leans bullish. It still leans bullish as of the close on January 6th. These are the actual titles here. If you Google them, you should be able to find the videos. The one exception is the rare Bollinger Bandwidth analysis appears on the website See It Market. And you should be able to get there by Googling this title. In addition to the charts that we've just reviewed and all of the affirmative answers over here, price pretty much telling us the same thing. On January 6th, intraday, the NASDAQ, S&P 500, and Dow all hit new all-time highs, telling us, for the most part, that the market agrees with our analysis and the current fundamental story that we're deriving from the charts. Obviously, all of that is subject to change, but as of January 6th, everything still looks good from a long-term perspective. We're not talking about what Monday morning will look like. However, we know price and these charts look good the first week of the year. Is there anything else that we can look at to get some insight? These risk-on, risk-off ratios can help. Typically, if the market is starting to get concerned, you will see some action inside of these risk-on, risk-off ratios. For example, the first week of the year, growth-oriented consumer discretionary stocks outperformed defensive staples by 1.55%. The same can be said for all of these. The risk-on part, or the numerator, outperformed the fearful or risk-off part, or the denominator. This is the S&P 500 relative to defensive staples. This is the S&P 500 relative to a diversified basket of bonds. Stocks beat bonds significantly the first week of the year. S&P 500 relative to the VIX Fear Index. Big win for stocks. High beta or economically sensitive stocks relative to defensive or low volatility stocks. SP high beta beat SP low volatility by 2% the first week of the year, and no red flags coming from metals or XME relative to more stoic and defensive utilities, a 4% win for XME. And if we take this chart here and we back up a little bit, we can see that markets can change their mind. The important thing, after a difficult period going backwards here from June of 2015 to July of 2016, we know harder and indecisive markets marked by multiple whipsaws are often followed by easier markets. A harder market, it's difficult to hold your gains, so your positions get profitable and then it's hard to hold on to the gains. Contrast that with the positions that we have after the election. Thus far, the market character does align with something like this, and it doesn't look like the whipsaws that we had experienced over the past 2 to 3 years. Only time will tell, which is why we have to head into next week with that always important, flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.